Floor is open. Okay, Paul, and then your neighbor. Please go to the mic, introduce yourself, and fire away.
Paul Wanacott, University of Maryland. I'd like to thank you for your presentation. As always, I found it stimulating. There are two stories that are often told about changing the American current account balance, one of which is you need to change exchange rates, the other of which is you need to change savings. And the second view is often put very strongly that almost ignoring exchange rates. I tend to come down on the same side as you do, that is one should look at exchange rates first, but as this other view is quite a strong one, I'd like your comment on it.
I think we are well aware that there are these two views. The view that we take is that it's necessary to change both the savings propensity and the exchange rate, the real exchange rate, in order to achieve an effective adjustment. That in terms of, if one is discussing this thing at an international level and one is wanting to agree on a set of targets that have to be mutually consistent, then it's really necessary to focus on exchange rates because that's where the interaction comes. It's not that one gets different answers by taking these two approaches. Indeed, it's necessary to assume when one changes an exchange rate that there will be a corresponding change in macroeconomic policy in order to offset the impact of a change in the foreign balance on internal demand. So, for example, in the case of the United States in recent years, if one wanted to cure the US deficit, then it was going to be necessary to raise US savings relative to investment. There's no dispute about that. The question is whether it's more useful to focus on that truism or to focus on a calculation of the exchange rate that would be implied in equilibrium. And because this is the way in which different countries interact, we felt it was more useful to focus on the latter. I don't know if you want to amplify that.
Okay.
Thank you. Dan Newman with Trade. Oh, can you hear me? Great. Using your conclusion and your analysis, if you were the IMF and going into the September Article 4 bilateral evaluation of China's exchange rate, what would your conclusion be? Are they fundamentally misaligned using the IMF terminology? Are they just substantially undervalued, which is what the IMF managing director called them 2 weeks ago? What would your conclusion be? Thank you.
Well, they're clearly both of those things. They're both fundamentally misaligned and seriously undervalued. I think that's absolutely clear from the figures that we presented. If you look at the table that I presented at the end, you'll see that the estimated appreciation in February, effective appreciation needed, was 18.4% or 31.5% against the dollar. And there's still a 25.7% change needed against the dollar, as in the first half of July. And that is even assuming that China only needs to adjust by 5.7% of GDP. Now look, last year China had a 10% of GDP surplus, and it had a capital inflow of long-term capital, not the short-term stuff, but the long-term serious capital of another 1.5% of GDP. So actually you could argue that they should be adjusting by 11.5% of GDP rather than 5.7%, twice as much as we suggested. So we're actually rather conservative, and yet we see an enormous need for a revaluation, and that's a revaluation. That's a misalignment if ever there was one. It's a serious undervaluation, and I'm very glad that the managing director said so.
I might even add, going beyond their study, that if I were the IMF, I'd add a third conclusion, namely that China has manipulated its rate substantially in order to preserve that undervaluation. I don't know if you all follow the numbers that closely. China's reserve accumulation numbers for the first half of this year showed that average monthly intervention totaled about $50 billion per month. That's twice as much as it was exactly 3 years ago when they announced they were moving to a more market-determined exchange rate. Now, the rate has appreciated a bit, but the intervention has doubled. That sounds to me like a less market-oriented rate rather than a more market-oriented rate. So I would add a third conclusion to where I hope the IMF will come out in a couple of months. John Maria? Here's a mic right here.
Gian Maria Milesi Ferretti. Gian Maria Milesi Ferretti from the IMF. First, a general comment on the interpretation of the results. It's important to highlight that you have the two biggest currencies in terms of weight, which are the euro and the dollar, both overvalued. So even if the absolute numbers are not huge for either the euro or the dollar, because those are the two currencies which have the largest weight for everybody else in trade, that implies that the needed changes in currencies elsewhere are going to look larger for that reason. This is why you tend to get larger numbers for the undervalued currencies, because they are, other things being equal, smaller than for the overvalued ones, because you have two big currencies that are overvalued. A couple of specific comments. One on the euro area. One issue is, of course, what would be the target current account for the euro area. One could make the case that because of demographic trends, you would want a current account in the euro area over the medium term, which tends to be in surplus, to account for the fact that the populations are rapidly aging and you need to draw down their assets as time goes along. And that would tend sort of to raise the target for the euro area. And even though the euro area is not running in the projections a large current account deficit, one has to take into account that the euro has appreciated relative to the time when these projections were made, and hence the actual current account is going to look worse at today's exchange rate. The other comment, and it's something a bit more on the specifics, on the size of the Swiss undervaluation. Switzerland is a country that has very big multinationals that, well, the banks not this year, but until last year, they tended to make a lot of money in investment income. A lot of the shares of these multinationals are owned by non-residents. However, the non-residents hold non-controlling shares in Swiss companies, so it's portfolio equity, while the Swiss companies hold direct investment overseas. Now, the current account measures the full returns, broadly speaking, on direct investment. That includes the dividends, but also those earnings that are retained by the firms and reinvested overseas. The equity liabilities, however, only enter the current account in the form of the returns on equity liabilities only enter in the form of dividends. So, on paper, you see that the Swiss are making a killing on their assets and are paying out only 3% or so on their liabilities, but that's really offset by the fact that the value of those equities is going up over time. So that tends to bias the surplus of Switzerland upwards relative to what really matters, which is the change in the net external position. If you adjust for that, you're going to lock off something like 4 to 5% of GDP into surplus. So part of the actual surplus of Switzerland is really fictitious in the sense that it reflects this accounting convention that for FDI you get the entire return on equity, while for the equity portfolio equity you only get part of it. So I think that may come down. Finally, I was wondering for the countries in Central and Eastern Europe whether you have a number of other cases where you have extremely large current account deficits. Did they not make the cut because of they are relatively small, or
Yeah. The first and third point I agree with completely. There is in fact a footnote which was inspired by Jean Maria on page 4, which attempts to say what he just said, footnote number 4 of the policy brief. But I'm glad that he has spelled it out in much more detail than we were in a position to do there. And that's absolutely right. I think maybe you could argue if the adjustment that you described is worth 5%, and then adding that 5% of GDP to the 3% surplus that a country normally gets, you can rationalize 8% rather than 6% in the case of Switzerland. Look, their actual current account surplus is still way bigger than that. They're still way undervalued. So even taking account of that, I think there's a serious undervaluation of Switzerland. East Europe, Central and Eastern European countries with large deficits. The one that we did catch was Poland. Surprisingly, we didn't conclude that Hungary was fell in the same category.
It's 5% instead of 8%. Hungary is 5%, Poland is 9%.
Right. Yeah, but I mean, we didn't have a big adjustment in the case of Hungary in the same way that we did. But there are other countries in that part of the world, which are smaller countries, in which the problems are much more serious. Some of the Baltic countries, for example. That's perfectly true, and we're not in a position to calculate each of those. The target current balance for the euro area, that it might be, you might aim for a surplus rather than balance, I think that's possible. It's within the realm where it could be discussed. But if you want a symmetrical method to apply the same rules to all countries, then I think one has to stick with something like 0 for the euro area, as we did.
Bill?
I just wanted to flag one thing that might have been a little bit ambiguous from the presentation, and it's flagged again on the reference to the rise in the euro since February. The dollar in trade-weighted terms is identical today to what it was in February. So none of our story, yes it is, look at the
Not the euro.
No, not the euro.
The dollar is down 3 in effective terms, and the euro is up.
Well, you have a different weighting. If you take the Federal Reserve's broad index of real exchange rates, it's identical today to what it was in February. I just looked at it. So I would submit that the dollar, and this is not just incidental. Some of the comments that have been made recently by, John Lipsky yesterday, so it sort of could be read as saying, well, the dollar's already adjusted. Now it's basically some cleaning up from Asia. By our numbers in February, and if I'm right, unless I've read the Fed's numbers wrong, it's still today 7% overvalued. The great bulk of that has to be carried out by an appreciation by the renminbi, by Japan, by Asia. So that was the only thing, and it's certainly true that the overvalue, 147 was our fear for the euro. It was exactly there in February. Now it's gone to 157, so it has overshot. I just wanted to clarify that.
Yeah, I think one has to add, particularly in the current volatile market situation, that there's an important issue of presentation of all these exchange rate imbalances. We here have talked for a number of years about the overvaluation of the dollar, and back when it was 20, 25, 30% overvalued, I think that was the right way to approach it. The dollar has come off by a trade-weighted average, the rear, by about 25%, 30% on some people's weighting schemes over the last 6 years. We've had a gradual, orderly decline of the dollar over 6 years that, on our analysis, has accomplished 80% or more of the target adjustment that we were positing back at that point when the dollar was clearly overvalued against practically everything. And so it was quite proper to call it an overvalued dollar. Now, with this more nuanced matrix that Bill and John have presented, you actually find that the dollar has come down by the targeted amount on their analysis, or even overshot a little bit, against a very large share of the world economy. All the European countries, Canada, Australia, New Zealand, a number of others. And so in characterizing it publicly, we put in the headline of the press release, and it's the way I'll present it tomorrow to the House Financial Services Committee, we've got a series of substantial undervaluations in Asia and one or two others that adds up to still a trade-weighted overvaluation of the dollar, but the issue is essentially getting those few but important remaining undervalued currencies to appreciate rather than to promote or seek or in any other way advocate a further generalized decline of the dollar. And I think that's important in presentational terms, market terms, and as we all think about talking about the issue and how to discuss it, I think we have undergone now a very important alteration in the nature of the problem and therefore the way it is properly characterized. Okay, there were several hands. Mohsen? Mohsen, why don't you go to the mic? Mohsen Khan from the IMF.
I just have one question, John. You started off saying, you weren't going to handle, you and Bill were not going to handle oil exporters, and then you went and stuck the largest oil exporter into your tables that I'm looking at. That's Saudi Arabia. The problem with oil exporters is, and I expect that's the reason you didn't have them in there, is it's very difficult to figure out what is the target current account for a country with an exhaustible natural resource. And that's the thing that we've been playing around with and trying to figure out whether, now you get the result in the table that I'm looking at, this is table 4, you get the result that the Saudi Riyal in fact is undervalued by 56%, 56.4 according to with respect to the dollar. And that's because the current account that you have there, in fact, has to adjust by 17.7% because you're using I assume 3%, when the actual current account is over 20%. We have actually calculated that the current account norm, if you like, for oil exporters like Saudi Arabia could very well be 25%, 30%. In fact, if you do, and we talked about it earlier, if you in fact take into account and value the wealth under the ground and put that as the net wealth of the country, which is what Jean Maria's suggestion is about net foreign assets. You add net wealth under the ground to net wealth that they hold in financial assets, i.e. they're just transforming one form of wealth into another form of wealth. You can actually discover that their current account target that they need to have, if you put that in there, is huge. And therefore, you find this bizarre result, I call it myself bizarre result, that the Saudi Riyal is overvalued by 100%. So I think the point that I want to make here really is it's still a very tricky issue. And my concern is that by just sticking it in without having said you're not going to deal with it, and then sticking it in and getting this result puts into question the methodology, and you know what? And the methodology for the rest of the countries is fine. So this is just a caveat that I would put in the paper. Thank you.
Well, I must say that I agree completely with everything you've said, and I leave it to others on this panel to defend that figure.
Bill, you want to take up that
Well,
proposal?
the most flack that we got from our colleagues here at the Institute was in the earlier version of this paper, which did not include a variant in which the oil countries had to adjust. And John was the most emphatic that they shouldn't adjust. I have been more of two minds on this, and I'm perfectly aware of the natural resource transformation story. You can carry that a little bit too far. If you'd done that 30 years ago when, the natural resources weren't known to, After all, we keep discovering more natural resources. I mean, I think there is a limit to the plausibility and feasibility of putting the value on what's in the ground and then making sure that you maintain the assets. It's a very tricky story. And there's also some sense, you can appreciate a certain amount of frustration by a surplus country that says, well, why don't the oil countries have to participate in this correction of global imbalances? So I'm not as much of a hawk or a dove, I guess. I'm totally leaving the oil countries off the hook, as John is. You'll notice a footnote in here that says that in order for us even to get to 47%, we have to implicitly shift the assumption for Saudi Arabia that it's no longer correction on the export side, because we know they don't adjust on the export side. It's got to be all on the import side. So implicitly, we have to assume that their import price elasticity is something like 2.5 in order to continue using the same parameter we were using. I think all of which is to say, yeah, this is very complicated, A, but B, if it's true, as it seems to be, that sooner or later the oil countries spend their surplus, it sort of comes down, then in some sense maybe it's all a sort of a wild goose chase to try to come up with elaborate models about going around and valuing what's in the ground and doing transformations and so forth, because at the end of the day, it's going to come down. But that's precisely why we also didn't think the net foreign asset variant was all that great. And we tried to specify in the paper that these are different ways of looking at it, but that's why we consider them variants rather than the central case. We make very clear in the paper that we prefer the central case.
I think this is one of those areas where the conclusion is more research is needed, because there are a lot of questions on the targets, and there are also a lot of questions on the instruments. How effective would an exchange rate change be in the case of an oil exporting country, and what alternative methods of adjustment are out there. So we plan to do more on that at the Institute, and hopefully we can fill the void. Okay, number of questions. One over here. Shenzhen, why don't you come up to the microphone?
Xiang Jinwei from Columbia University. There are two questions. So Germany is one of the large economies that has run a very large surplus. It's not in your table, presumably it's a member of the Euro zone. However, last time I checked, Germany is out of German government's own initiative. It joins Euro, and nothing prevents, as far as I know, that Germany withdraws from Euro if it chooses so. So therefore, one conceptually could think about a German Euro, a French Euro, and an Italian Euro. Now, given that Germany is running very high current account surplus for many years, so I'm imagining when we apply your methodology, there's a very straightforward translation there. German Euro must be considered substantially undervalued. The question is how much, and maybe you can do this calculation in your head much faster than I do. So the question is from that description to prescription. So would it make sense to go to the prescription of countries that's found to be substantially undervalued their currency? Should go on to, in the case of Germany, withdraw from Euro and do something that would moving towards narrowing its current account surplus. That's question number one. Question number two, I now live in New York, and New York happens to be consistently running a current account deficit vis-a-vis the rest of the US, because most of the things we consume in New York tend to be produced and bought from outside New York. And that's matched by a persistent capital account surplus vis-a-vis the US. And we don't think necessarily it's desirable to impose a current account 3% ban on New York and the rest of the country. So therefore, so I guess the question inspired by that is it obvious that now the exercise take it as given that it's desirable to narrow current account either surplus or deficit within a relatively narrow band? Is it really they're self-evident that it's necessarily desirable to put the current account into that band? In fact, Mosin's example about oil producers is one of those examples that the band, 3% ban is arbitrary and may not be as sensible. And there are a set of countries like the New York and the rest of the U.S. example, right? U.S. is financially much more advanced than other countries. Perhaps could one make a case that for a set of countries with lousy financial institutions, it might make sense for them to trying to keep their investment in a financially more advanced economy like the US? So that's my second question. Thanks.
My view is that if you have a separate currency area, you have to maintain some balance with that area vis-à-vis the rest of the world in a way that is really not necessary for an individual state. In the United States, I mean, Texas maybe has as big a surplus as Germany. Who cares? It really isn't relevant. The fact there's a German surplus is offset by a Spanish deficit, an Italian deficit, and that doesn't threaten the future of either area as long as it's within the area of a single currency. If it's a multi-currency area, then you get into international problems and you have to face it, and there should be, in my view, be some limit.
Yeah, we at the Institute do tend to put a lot of emphasis on current account imbalances, and sometimes we're criticized for that. But I must say we've never gone to the extent of suggesting that to correct them, one should break up the euro area. Bill. Bill.
There is a footnote in the policy brief about the work by Reinoff, Rogoff, and Savastano saying that developing countries tend to get into trouble when their debt to GDP is over 40%. And if you work that through, it comes out to sort of a 3% benchmark. So point one, I think there's a certain legitimacy to a 3% notion for a lot of countries. Point two, what about the United States? Well, the United States has all these special benefits about differential returns. It's the debtor in its own country, that currency that could change. But basically it's sort of linchpin of the system, and so you don't want the U.S. to get too far out, and that's why we've tended to say that 3% is a good working target for the United States, despite all these true stories about how it's got a wonderful, well, it used to be true, a wonderful capital market. And so, you know, I don't think that, I think these kind of targets sort of make sense to start with, but we're certainly aware that even some of our close associates like Richard Cooper would argue that, hey, you know, the United States could have a larger deficit. But on those particular points, I wanted to make those clarifications.
Bill?
I have a few comments. First, I always enjoy Bill and John's work, and I enjoy this. I find it very creative and especially very interesting the way you went from 35 to 34. You know, I'm always encourage you to, when you're doing quantitative work, not to let your brain go into plastic, and I'm glad you didn't. I had a couple of comments. Number one, the world undergoing, you know, a huge shock, the world economy. Probably the largest shock since post-World War II. We were trying to integrate Western Europe and Japan into the world economy. Now we're trying to integrate China and India into the world economy. And from a labor force perspective, it's probably a bigger shock than it was when we integrated Western Europe in. So it's not clear anywhere near equilibrium in this adjustment process, so it's hard to tell where the targets are. The second thing is, not only China and India need to adjust, but so does Western Europe and the US, right? So it's not clear to me that capital flowing downhill, it's not clear to me which way downhill is. Is downhill from some of these countries to the US and Western Europe, who also need to do a lot of investment to restructure, or is it the other way? So that's the other. But the third thing is real stop, and which has to do with your results, and that is we have the concept from economic perspective of internal balance as well as external balance. And my view, when I worked at the Fed, was always that we knew a lot more about internal balance than we did about external balance. So we ought to set our policy targets so GDP is close to potential and inflation is close to our target, and let the external go where it goes. So given number one, we knew more about what those things were, and clearly voters vote more on that. What's your view on kind of the point, and what does that have to do with the results? And that is, it looks like if Japan appreciates 10%, they are not going in the right direction as far as price stability and output close to potential. It seems to me that their output would decline if you had feedback, and they'd go back into deflation. Thank you.
The point about, I mean, China and India, sure, they're important and they're bound to influence the results. I don't think one throws overboard all the analysis of that the rest of the world because there are big changes in prospect there. I think one still has to try and formulate some targets and treat those countries in the same way. And if in fact one ends up in a somewhat different position, well, that's fine. I don't see that as a big problem. For capital, which way should it flow? I think our view is clearly that it's perverse to have capital flowing from developing countries to developed countries. That there are, on a long-term basis, I mean, one knows that there are shocks to the system, and in the interim, all sorts of things can happen. But as a except where there's oil or some extraneous consideration like that, it does make sense to think of the norm as being a situation in which capital is going to flow from relatively capital-rich to relatively capital-poor countries. And that's the position, even though there's a need for continuing investment in Western Europe and whatever. And then finally, on macroeconomic balance, well, I agree that Japan is the big consideration, the big reason that one is worried about recommending that the Japanese should appreciate strongly. And there was a period when that was the dominant consideration in my thought. That has more or less come to an end. I think one still has to be a little bit cautious in the case of Japan, but there is now a rate of growth in Japan that's comparable to that in the other advanced countries, and the extreme weakness and vulnerability of the Japanese economy appears to have ended, and so therefore perhaps one would allow a little bit more, want to allow a little bit more time for their adjustment, but that they should have this objective and be thinking about an equilibrium exchange rate of 90 yen to the dollar seems to me desirable.
Okay.
Go ahead, Bill.
I'd just like to broaden the point a little bit, though. I think there is a problem of inconsistency of countries that basically have a heavily export-oriented strategy in order, I mean, China could tell similar stories. You know, we couldn't possibly reduce our current account surplus from 10% of GDP because otherwise, no, we would have all this unemployment. A number of emerging market economies have rediscovered mercantilism as the motor of growth and are running surpluses. And basically, if you have a bottomless pit of a U.S. external deficit that can absorb unlimited amounts of deficits and never raise any questions about the eventual sustainability of the U.S. External asset position, et cetera, maybe you could tell a story where everybody should be a mercantilist and you can get away with that and it'll all add up. But I think, you know, if you start enumerating some of these big surplus countries and try to tell stories about how terrible it would be if they reduced the surpluses because they'd have domestic problems, you do get into this global inconsistency problem, global unsustainability. And that simply implies that there is an imperative, it seems to me, to find domestic sources of demand in these economies that replace the over-reliance on the external demand.
Just to elaborate the Japan point slightly and to remind everybody, Japan has undergone 10 to now 15 years of essentially deflation or flat prices. And in terms of the calculations here of real effective exchange rates, that has led to a massive improvement in Japan's competitive position. and amounts to a substantial undervaluation of the currency. I haven't checked at the latest level for the yen, but until quite recently, the real rate of the yen was weaker today than it was 10 years ago in 1998, when even Bob Rubin was willing to intervene jointly with the Japanese to strengthen the yen because it had gotten so weak. It was 145 to the dollar at that time. Now it's 105, but in real terms, that's about the same because of the prolonged deflation of the Japanese economy. So if anything, their estimate of an equilibrium rate of 90, maybe like in their China estimates, are really understating the numbers. Some of you will remember that the yen went to a little stronger than 80 to the dollar back in 1995. If you updated that in real terms to today, it would be a yen-dollar rate, I think, of about 55. Now, they're not saying it should go that far, and that was probably an overvalued rate for the yen. But Japan is an extreme case in terms of the difference between nominal and real rates because of the prolonged period of deflation, and therefore any estimate of its misalignment has got to take that into account and recognize how severely undervalued it has become over this period. Okay, a couple more.
Can I just say, I mean, we clearly do take that into account, but even, I think the point I want to make is Bill's parallel between China and Japan, which I just don't think is valid. The Chinese could easily expand demand by fiscal policy in order to use some of the additional capacity that would be released by an appreciation. Japan would have a lot more difficulty in doing that, and I do think that that's an important distinction to bear in mind.
Okay, back in the back. Yeah.
Thank you very much. On with the Chinese empathy. Sorry. I agree with Mr. Williamson that if you want to correct world imbalance, you should pay attention to both exchange rate issue and the saving rate issue. But the problem here is that whether the continuous depreciation of dollar could really help to correct the world imbalance. I think that maybe the answer is no. During the past 4 years, dollar has already depreciated more than about 40%, which I think deteriorated the world imbalance. It caused more, it's contributed to a high oil price, world asset bubble, as well as more disorder of capital flow. According to your study, the dollar should depreciate further about 8%. I think that could cause more trouble to the world economic stability, especially at times of the U.S. subprime mortgage crisis. So my question is, do you think U.S. should take a more responsible dollar policy that could really help to correct the world imbalance? Thank you.
Let me try to answer that if I may, because I've got some of those numbers in my head for tomorrow's testimony. First of all, you raised the question, has the decline of the dollar to date been effective in reducing the imbalances? And the answer is an unambiguous yes. The dollar's come down by a trade-weighted average of about 25% over the last 6 years, gradual and orderly, no hard landing, no free fall. Over the last 18 months, the U.S. current account balance in real terms, as included in the GDP, has improved at an annual rate of $150 billion. That has been stimulating U.S. growth by more than a full percentage point a year. And in fact, as I point out in a recent op-ed in the FT, it's accounted for the totality of U.S. GDP growth over the fourth quarter of last year, first quarter of this year, the last two periods for which we have data. It's kept the U.S. out of recession. So it's been very timely, but it's also been very substantial. on our own projections here, the U.S. real trade balance will improve by another $150 billion over the next 18 months through the end of 2009, providing further positive adjustment of the international imbalances, and fortuitously, given the sluggishness of domestic demand in the U.S., some modicum of economic growth. If you look at the new global forecast from the OECD, just released, projects global economic growth out through 2009, they see 80% of total U.S. GDP growth coming from the further improvement in the U.S. external position, the net exports of goods and services in GDP terms during that period of time. Now, in nominal terms, the U.S. current account deficit has not come down as much because of the increase in oil prices. So the real gains to the U.S. economy, job creation, output stimulus, has been much greater than the nominal improvement. Even the nominal deficit has come down from its peak of slightly over 6% of GDP in 2006 to about 5% now, and on Bill's models, it's headed toward 3.5% to 4%. So I think you put all this together, and the unambiguous answer is the exchange rate changes work. They've got to be, as John said, supported by proper domestic policy. In the case of the U.S., that required a slowdown in the growth of domestic demand. It's gone a little slower than we would like. Nevertheless, a move in that direction was required and is part of the adjustment process. But I don't think anyone could seriously challenge the effectiveness of the currency changes plus associated macro changes in bringing the international imbalances down. Now, you raise a second point. Hasn't this been terrible because it's driven up the oil price? There is no, repeat, no systematic correlation between the exchange rate of the dollar and the world price of oil. No systematic correlation. I invite you to look at Table 2 of my statement for tomorrow, which is you can pick up on your way out. Also the analysis in there, drawing on Dan Yergin, Phil Verlager, and others. If you look at most periods in the last 30 years, the oil price and the dollar have actually moved in the same direction. In the mid-'80s, the dollar was falling sharply after the plaza. The oil price collapsed. In the late 90s, the dollar was rising, and the oil price bounced up from its low in 1998. Look at the last few days. The oil price has plummeted, not because the dollar went up. Look even at the last 6 months. As Bill pointed out, the trade-weighted dollar has been about constant. The oil price has soared. So whether you want to take very short periods or very long periods, you do not find any, repeat, any systematic correlation between the exchange rate of the dollar and the price of oil. There are lots of other factors I can mention, like other commodity prices, whether traded on exchanges or not, have gone up more or less with oil. You blame that on the dollar. You know, it's pretty hard to make that case. So there has been a tendency in some circles to note this sort of broad, similar direction of dollar and oil price move over the last 5 years and say, aha, they're bound to be related. If you want to hypothesize why the oil price has changed, obviously lots of reasons. Yergin points to 4. World demand has grown twice as fast in the last 5 years as the previous 5. There have been what he calls cumulative supply disruptions of 2 to 3 million barrels a day. The price of finding new oil has doubled over the last 4 years, slowing the supply response even further. And yes, probably some flight to commodities because of concern about inflation, and that may be a common cause of dollar decline and commodity price rise, but it's hard to see the causality going from exchange rate to oil price. No.
The other part of your comment was that if the dollar went down any further, it would be very destabilizing for the credit markets, et cetera. But if you look at the FEERs, we're saying just the opposite, that it is not against the key currencies where the change needs to happen. It is an appreciation by some of the Asian currencies. And those are not the currencies that send up the red flags in the financial markets. A correction of the East Asian currencies would be seen very much as a region-specific adjustment, long overdue, rather than the death knell of the financial markets because the dollar had once again tumbled.
Having said that, let me just add one final point, and to be more sympathetic, in essence, to the question you raised. Despite our analysis that the dollar has gone most of the way and has gone far enough against the euro and the other currencies Bill just mentioned, we of course don't know what the markets may do. And if the markets lose confidence in the dollar again and push it down sharply again, that could be very disruptive to the current U.S. and through that global economic circumstance. I mean, the Federal Reserve is already in something of a dilemma, I would say, facing the sluggishness of the U.S. economy and financial fragility on the one hand versus the rise of inflation pressures on the other. If that dilemma is compounded by another sharp decline of the dollar, then the Fed would be very hard put, to put it mildly, to reduce rates further to deal with financial fragility, might even feel a compulsion to raise rates to cope with the inflationary pressure of a further dollar decline, and that then would be perhaps very disruptive to the U.S. economic outlook. So in that sense, a further dollar decline could be quite serious. We might in fact need a new policy tool and begin thinking about joint intervention in the currency markets again. That's a story for a different day, but if you want to take a look at my testimony on that, I invite you to do so. Let me thank John and Bill very, very much for the presentation. It's food for thought. Meeting adjourned.